Well, dear students, welcome to our third discussion regarding our introduction and overview and in-depth study of stocks. And in this presentation, we will be taking a look at stock transactions and commissions and fees, and then turn our attention to these market indices that we've been discussing all semester long so far. But now we're finally ready to define them and study them. A little strange, but that's how it works. Slide 35, the types of market transactions. There are more than these, but these are the big 3.5 sort of, because the third and the fourth one are basically very similar to one another. The market order. In my humble opinion, that's the one you should use. You want to buy the stock? Buy it. You want to sell it? Sell it. And when you put in a market order, you know it's going to happen, assuming that it's a real company with lots of investors, many investors who are buying and selling your shares and interested in the company. If it's one of these penny stocks, well, maybe not. You might not get somebody to buy your shares because they've all run away and left you holding the bag. Yes, that's a market order. Now, what's a limit order? Well, a limit order is a little tricky in that you're saying, yes, I'll buy these shares or I'll sell these shares, but I want it to be at my price. So, for example, if a stock is selling for $25, but you don't want to pay $25, you can put a buy order in at $22. And you are guaranteed to pay no more than $22. Now, you may pay less than that. Probably won't. You won't. You'll pay $22. And for the same exact idea is if you want to sell a stock and it's selling currently at $25, but you're not going to take anything less than $27. So you put in a limit order at $27. Now, what's the downside? Well, you might never buy the shares if they keep rising. You might never sell the shares if they keep falling. But you're guaranteed, if you do buy or sell your shares, to get the price that you have said you wanted. A stop loss and a stop limit are orders that say, look, once this trigger point is reached, then in the case of the stop loss, it becomes a market order. In the case of the stop limit, it becomes a limit order. So why would you want to do this? Well, people do this for various reasons. The stop loss, or just called the stop order, is often used to stop a loss. You have this stock that you bought maybe for $15 and it's now selling for $25. And you don't know if you want to keep it or not. But if it ever falls below 22, boom, you're out. You want to get out. So you put in a stop limit that says, look, stop loss. If it goes below this amount, then sell that stock immediately. Bing, just get rid of it. Now, the stop loss says it becomes a market order. So if it falls below 22, 21, 20, you don't know what price you're going to get. It becomes a market order and you will sell at whatever amount somebody else will buy it for. The stop limit becomes a limit order once it hits that trigger point. So you're saying, I want to sell at 22 and not less. Yeah. Look, although you can use limit orders to buy or sell at the price you want, and stop loss and stop limit orders to lock in profits or protect against losses, remember that they trigger automatically. If for some reason you change your mind, it's too late. By the time you've run to the terminal, to your PC, or maybe on your cell phone or whatever, to cancel the order, it's too late. It's already gone. Or you've bought it. Are you with me? I recommend to people, use a market order. You want to buy it, buy it. You want to sell it, sell it. And here is a table that's from your book that describes them in a little more detail. And I know it's a little tricky, the difference between a stop loss, stop order, and a stop limit order. But what you have to understand is just the difference between a market order, which means buy or sell whatever price is available. Limit, you get your price, but you might not get it if it never reaches that price. And then the stop orders are basically triggered by a price that it hits. If it's a regular stop, a stop loss, it becomes a market order. If it's a stop limit, it becomes a limit order. Okay? And if it's a little tricky, I apologize, but make sure you understand the difference between market, limit, and stop, even though there are two flavors of stop. There are actually more than this, but these are the biggies. Make sure you understand these 3.5 transactions. Slide number 37. Buying on margin and selling short. If you're going through the book and you're looking at chapter 2, they spend a great deal of time on this in chapter 2. Wrong, in my humble opinion, wrong. We wait until the end of the semester to discuss these. All you need to understand about these two is on this slide for now. Later on, we're going to go into detail about these. You can borrow money from your broker to enhance your return. Borrowing money to make an investment. Yeah, well, it's more risky, but it can enhance your returns. It can also enhance your losses. And you can borrow up to 50% of the purchase price of a stock. Selling short is borrowing stock. Instead of borrowing money, you borrow stock and you sell it now in the hopes that the price will go down. What? You sell stock that you don't own? That doesn't sound legal, does it? Plus, we're hoping the price goes down. Yes, remember we said buy low, sell high? Well, you can do it in reverse. You can sell high, buy low. You can turn around and buy it back after you've sold stock that you don't own. And I know it turns your head around, doesn't it? The first time I heard it, I thought, that doesn't sound legal. Don't you have to own something before you sell it? No. You can borrow it and then buy it back. You must buy it back, by the way. The book spends way too much time discussing this in chapter 2, both of these. We'll discuss these later in the semester. My advice to you is never sell short. Peter Lynch says never sell short. And who am I to argue with Peter Lynch? It's simply too risky. Using a margin account can be useful once you have built a substantial portfolio, but it's still more risky than just buying the shares. It also allows you to borrow from your portfolio without selling your stocks, which can be useful, and we'll discuss these in detail later on. For now, all you have to know about buying on margin is you're borrowing money from your broker to enhance your return, and selling short, you're borrowing stock and hoping that it goes down. Right, if you think a company is going down the porcelain oasis, like Sears, Kmart, or whatever company you think is going down, you can sell the stock short and then wait for the price to go down and then buy it back. And that's all you have to know for now. Remember, both of these are risky. Selling short is really risky. Slide 38, transaction costs. Now let's spend a few slides, a little bit of time talking about transaction costs. Traditionally, transaction costs were in the 1 to 5% range, sometimes higher, and the largest percent of this cost was the broker's commission. Well, that's all changed now. Deep discount internet brokers have driven the commissions down to as low as $5 per trade, and a few firms used to offer free trade. There's another one now called Robinhood or something, Robin something or other, like, Robinhood, the steal from the rich and give to the poor. And it's giving free trades. But have transaction costs really gone down? Well, yes, the truth is they have, but more and more the cost is being hidden from you, the investor, and especially from the internet garbage brokers. Now, I don't like that term. Excuse me. I didn't make it up. Somebody else said it, and I said, why do you call them internet garbage brokers? And he explained to me what they're doing, and I went, okay, now I understand how they can do it for so cheap. Okay, I got it. I'm going to explain it to you, too. It's still much cheaper than it used to be, and we'll discuss the hidden costs in a bit here. So slide number, what are we on here? Slide number 39. Here's an example. A deep discount internet broker, which shall remain nameless, Scottrade, offers trades for $7. In the fine print of the client-broker agreement, is included a provision that for allowing the broker to solely utilize exclusive stock dealers and market makers. Remember them? The quoted price is simply the best price available, but at any given time there are dozens of prices quoted as dealers and market makers are competing for buy and sell orders. The chosen dealer doesn't necessarily have to have the best price. So instead of paying $20, you might pay $20.05. The investor sees the $7 commission on their confirmation. The investor does not see the extra $5 they paid for a $100 share purchase because of the 5-cent differential, the spread. Now, my understanding is that this has become far less commonplace just simply because of the sheer competition going on. And it's not 5 cents anymore, it's 0.1 cent. I mean, it's just so much competition driving down the cost that because of the sheer volume of shares that are trading every day. But still, you're paying more than what you think you're paying, or you're getting less when you go to sell. And here is what Scottrade used to put on all of their email trade confirmations. Now, I haven't checked in recently if they're still doing this or not, so I really should. But this is what you used to get. And nobody understands what this is. They use all uppercase, and people think they use all uppercase so they want us to understand it. No, they use all uppercase because they know you won't read it. It's harder to read all uppercase. Try it. It's uppercase is great for titles, but it's terrible to read. So let's see if we can figure this out. Scottrade Incorporated receives remuneration for directing orders to particular broker-dealers or market centers for execution. Such remuneration is considered compensation to the firm, and the source and amount of any compensation received by the firm in connection with your transaction will be disclosed upon request. Yeah, I know. When I see stuff like this, I just want to break out in plain song because Gregorian chant is the only thing that makes sense to me. And I mean, this stuff might as well be Greek or Latin or whatever. What's remuneration? It's a fancy word for money. I told you we'd come back to that word later eventually. So what's going on here? Scottrade is being paid a kickback. They don't use that term. From whatever particular broker, dealers, market makers, market centers they're using. And they'll tell you how much it is if you ask them, but you don't even know what you're asking. In Scottrade's defense, folks, at least they prominently disclose this relationship in every trade confirmation email that you receive. Many other brokers just hide it in their customer agreement fine print, and the customers are really never aware of this relationship. You see, that's when I realized, oh, I understand why you called it internet garbage. I think that's still too cruel. I just wish they would explain it better to their clients, right? Disclosure, disclosure, disclosure. Slide 41. The Securities and Exchange Commission says that your broker has a duty to seek the best execution that is reasonably available to its customers' orders. But it's not a guarantee. The Securities and Exchange Commission requires broker-dealers to notify their customers if their orders are not routed for best execution. Typically, this disclosure is on the trade confirmation slip you receive after placing your order. So says Investopedia, and obviously this is what we just saw on the previous slide. Determining whether a customer got best execution can be very difficult. Here is an example of the Securities and Exchange Commission trying to enforce the rules. And this is from a law website, right? And not doing a very good job of it, if I understand the verbiage on this website. I'm not a lawyer, folks. Go bug one of the lawyers on campus. I won't name any names. You figure out who they are. Let's not get angry at me. But yes, I think my layperson, as a layperson, not a lawyer, is that they really weren't doing a very good job of enforcing the rules. Slide 42. The Securities and Exchange Commission was looking into making the cost more transparent. Not anymore. Possibly showing the customer the difference between the dealer's price and the best price available at the time of the transaction. Maybe even, showing the total cost of the transaction from the markup and markdown Mark up when you buy, mark down when you sell. Needless to say, the deep discount brokers cried that it would drive up the cost of commissions and ultimately hurt the consumer, and the proposal died. So it is up to you, dear would-be investors, dear soon-to-be investors, eventually investors, if you're getting the best execution. But how can you, a lone investor, determine if you're getting the best price if even the Securities and Exchange Commission has trouble watching over the brokerage companies? Well, you have to ask your broker. You have to just be plain and say, look, is this what you're doing? And if so, would you please tell me how much you're making off of these deals? Because I'll tell you, I mean, we give the best execution. I've watched it. It's hard to watch, folks, because you're watching the data as it flies on the screen by. But then we charge more. You know, our brokerage firm charges more for commissions, and so there you understand. You know, so you're getting the best execution, but you're paying a higher commission. The one that, again, here, this is I haven't checked lately. You got to do your due diligence because I haven't kept up with this. But the one brokerage firm that charges much lower than the rest, or with the charges along the same lines as the deep discount broker, is Schwab. And Schwab, at least the last time I checked, 2-3 years ago, they were not doing this. They were getting the best execution that they could find on the system. So there you go. There's an unsolicited referral to a competitor. Are you with me? You understand? Okay, good. Because it's up to you. It's up to you. And then you would say, okay, yeah, I know they're nickel and diming me. Okay, it's not a big deal. I don't buy that many shares. I don't sell that many shares every year. And in the reality, it's not a big deal for most people. But if you're buying a lot of shares, if you're a mutual fund company or you're a pension fund, you're not too happy about what's going on. Indeed. Let us discuss now high-frequency trading. And, folks, we could spend the entire semester discussing this because it's in the news and it's very exciting. And if you have the time, I really recommend to you to read this one book called Flash Boys. It's a lot of fun. And Michael Lewis will be the very first person. He's the one who wrote it. He'll be the first person to say we really don't know how much more we're being charged because of these high-frequency trading systems. Because what's going on here, folks? Remember we said that the people on the floor, they're gone. There's a few people on there doing a few deals, but all the transactions are being done electronically. And so these companies are using computers to transact large number of orders at very fast speeds, millions of transactions per second, There is little doubt that high-frequency trading has reduced transaction costs. Why? Because it's all computerized, right? There's no people yelling and screaming at one another, and it is much more efficient and much more able to handle the billions of transactions. Well, billions of shares, not billions of transactions, but the billions of shares that are traded every day. However, at the very same time, nothing's perfect, right? The high-frequency trading firms have been accused of using their ability to transact at the microsecond level to front-run investors. So what does that mean? It means they see your transaction coming down the pike, and they're fast enough to jump in front of you, buy the shares from somebody else, and then turn around selling to you at a higher price. Now, it's a tiny amount. And the Securities and Exchange Commission kind of knows that this is going on. And if you read the write-up I put up on the website and Canvas, you'll see that they're looking into it, but they don't want to throw the baby out with the bathwater. All right, now as I said, if you're an average retail investor, it's pennies. It's not that much money. But if you're a mutual fund, and you want to buy 100,000 or 1 million shares, or you want to sell 500,000 shares, we're talking serious change now, dear students. And so the mutual fund companies are not too happy about this. One firm, IEX, and that is fighting back and has the backing of some very large market players. It first started with Capital Group. They're the people who run the American funds. And then T. Rowe Price and Vanguard and Fidelity and the Texas pension plan and the California pension plans, they all said, okay, if you can come up with a way so we're not getting, basically screwed by these people, we'll back you. So what they've done is they've created a speed bump. This is so cool. You really want to read Flash Boys and then read some of the articles, and they're all over the place, and I have a few on Canvas and on my website about what's going on now. And the hero of Flash Boys, I got a couple of videos, links to videos. They have a speed bump so that nobody, the high frequency trading firms, cannot jump in front of you and front run your transaction. And they came up with a way to do this, the technologically way to do it. And they went to the Securities and Exchange Commission and said, can we be like the New York Stock Exchange? Can we be a stock market like the NASDAQ? And the high frequency trading firms fought like cats and dogs not to let them do it. And they did it. The Securities and Exchange Commission approved their bid. So stay tuned for further developments. And here's a great article from the Los Angeles Times, because the Capital Group is based in Los Angeles, and they go way back with the LA Times. So the LA Times keeps tabs on what the Capital is doing, which is interesting because nobody else does. They're kind of invisible. How much are we talking about here? Well, as I said, Mr. Lewis will be the first one to say that nobody really knows. But the estimates range from about $5 billion to $15 billion a year that these high-frequency trading firms are taxing us, if you will, as a part, instead of saying stealing from us. And it sounds like a lot of money, and it is, but when you look at a $17 trillion economy and that billions of transactions take place every day, it's really not a whole lot of money. It's still not fair. I'm not condoning it. But it's about, let's split the difference. Let's say it's 9-10 billion. That's about what is bet every year on the March Madness NCAA basketball playoffs. So it really isn't a lot of money in the grand scheme of things, but it's still not right. And these companies really shouldn't be doing it. And we're going to see what happens, because now the New York Stock Exchange, and I don't know if the NASDAQ's done it yet, but they are proposing to put in their own speed bump. Exactly. So they're saying, okay, we'll come clean. This is exciting stuff. I don't know, maybe for you, not for you, but for me and anybody who's involved in the markets in a big way, this is really, really interesting, because the regulators can't keep up with the technology. So we're using technology to keep up with the technology. Pretty exciting. Slide 44. Now, speaking of the technology and newfangled things, let's now jump 50 years in the past, 40 years, 30 years in the past. You see, traditionally, everything was done on the floor of the exchange and people screaming and hollering at one another. And so you had what were called round lots. They were 100-share increments, or multiple shares of 100. And that's the way they wanted to transact business, because it made it faster. Instead of saying 100 shares at 25, they'd say 25. And they would either move their hands away from them, which means they wanted to sell 100 shares at $25 a share, or they would pull their hands toward themselves and they would say 25, which means they wanted to buy 100 shares at $25 a share. Do you understand? And it used to be in eighths. 25 and an eighth, 25 and a quarter. Yeah, right, exactly. Now, what happens when somebody wanted to sell 17 shares? Well, they would have to say 17 shares at 25. See, if they said 17 at 25, that meant 17 round lots, or 1,700 shares. But if they say 17 shares, see, it slows them down, because now they have to use the word shares. But that's all gone. It's all gone, folks. It's all electronic now. This is a history. And so, but still, some people recommend that you only buy and sell in 100-share increments. That was years ago. And what they would do is they'd tack on an extra 12.5 or 25 cents. Now it's less than a penny or 5 cents or so. It's just not something you have to worry about. So don't worry about if anyone tells you have to buy 100 shares or sell 100 shares. Tell them that's old news. But it still is in the industry. So you need to know what a round lot is, 100 shares or increments of 100 shares, or an odd lot, which is less than 100 shares. A mixed lot is when you have 117 shares, right? It's not divisible by 100. So the differential, the odd lot differential, is the extra amount that you have to pay when you buy or receive, the less you receive when you sell. But don't worry, just don't worry about it. It's inconsequential. Other than you have to know what it means because you're now the investment guru for your friends and family. So you understand that you have to understand these things. Make sense? Make sense? Did I explain it well? Think about it. You're on this floor of the stock exchange. You have to sell 200 shares. You say 2 at 25 and you push your hands away from yourself. And that means to all the other brokers, they know you are offering to sell 200 shares at $25 a share. If you said 3 at 25 and you pulled your hands toward you, you're saying, I'll buy 300 shares at $25 a share. And if it's an odd lot, then you have to say 3 shares at $25 a share. And it slows everything down. But doesn't slow everything down now because it's all computerized. Slide 45, reading stock quotes. Different sources will contain some, all, or more of these statistics, but always remember that the quoted prices are not the only prices available. Remember the Casas de Cambio? There's lots of different prices in front of your face when you go down to San Isidro or TJ. And the same thing is true online. There's lots of different prices at any one time. The quoted prices are just the best prices available. Plus, usually, unless you pay extra, you're seeing the price 15 minutes ago or 20 minutes ago, or you're not seeing the current price. And so what do we see? The current price, the trading hours, the bid, the ask. What's the bid and the ask? Hang on a minute. Open, high. Oh, wait, no, we discussed that already. Open, the bid and the ask, or we discussed that in the previous. What are people willing to pay you? What do you have to pay? Retail, wholesale. Retail is the ask. That's what you have to pay. The bid is what you're going to get. Now, the ask is always the more expensive one. If you have to ask for it, it's too expensive. Right? Open, high, low, close, the 52-week high, the yield, the PE ratio, the volume, the change, the year-to-date change. So we're going to do some research, and you don't have to use the Wall Street Journal on page 46. Oh my God! You mean you actually wait until the next day to find out how much your stock is worth? Oh, how 20th century! All the newspapers have gotten rid of their stock quotes because they know that they also got rid of all their classifieds, almost all, because it's all gone online, except for the venerable Wall Street Journal, because I guess it's just tradition. But no. You can, if you want, go to the library, pick up the Wall Street Journal, and read through it. Barron's, read through that. Investors Business Daily, which is the LA Times version of the Wall Street Journal. It's not that good, and in my humble opinion, not that it's bad, it's just not that good. And the Wall Street Journal actually now is owned by Fox News, and so I don't trust them, but that's, it's a political statement in my humble opinion. And they don't even do the Dow anymore. Isn't that interesting? They let S&P 5 do it. S&P, well, later, we have to deal with that later. Slide 47. Now we're talking. You're going to go online, right? Especially you millennials. I mean, oh my God, I don't pick up a newspaper. For years, folks, Yahoo Finance used to be the best free finance website on the internet, period. But they've destroyed it, along with the rest of their website. And I just got so upset that I sent an email to the new, he's the CEO of Verizon, but that's the new owner. Verizon is buying Yahoo. So I sent an email, and I didn't think, I figured the staff would read it and maybe give him some information, but they probably get dozens and dozens and hundreds of emails every day. The next day, I got an email back from him, directly from him. I posted it on the website, it's in Canvas. It turns out he used to live across the street from Southwestern Community College. So I used to live in. While I was teaching, he was there. Very interesting. So I'm using Google now. Google is very rudimentary. When Google came out, they said they'd never have a very good, they even said it publicly, we're not going to have a very good finance website. And it is. It's very rudimentary, but it works. That's what I like. I like that it works. I'm a big fan of Craigslist, which is very rudimentary, folks. There's nothing special about that, but it works. So that's what I have a video of on how to use Google Finance. Now, a lot of people tell me they like Bloomberg. I don't really think it's that great, but I think if you're going to use Bloomberg, you're going to want to pay for it because they have the pay site people rave about, and I've never even used it, so I don't know. MarketWatch is the Wall Street Journal's free website. The Wall Street Journal website you have to pay for, and again, I've seen it. I think big deal. It doesn't do anything for me. MarketWatch is not bad. Morningstar is not bad either, but they're always hitting you for that premium service. Every other time you have to click no, thank you, no, thank you. So use Google. It works, and you tell me which other ones you want to check out. CNBC. Somebody told me about big charts, and I thought, okay, let's look at big charts. You tell me which ones you like, and maybe we'll create some presentations for them. But right now, all I have is Google, and that does the job because you're going to do some research for your assignment. That's one of the things you're going to do for your assignment, and you can go to the library. You can look it all up on the library, or just go online. Have fun. Tell me which ones you like. Okay, stretch. I know maybe I should stop here and create another presentation, but no, I'm going to keep going. So you can pause it and maybe come back a little bit later because now we're going to discuss market averages and market indexes. And yes, I'm thinking maybe this should be its own little presentation, but no, I'm going to keep going. We've discussed these things also so far this semester. When we talked about the S&P 500 and the index funds that go along with it. And we talked about the Dow Jones Industrial Average and how the stocks have done in the Dow. But now we're actually going to define these. How can we say that stocks have returned approximately 10%? It's actually more, but we tell people 8, 9, 10% over the past 70 years. How can we say that? Well, the industry uses market averages and indices. These are benchmarks, standards that are used to measure the general behavior of securities prices by reflecting either the average price behavior, that's a market average, or the relational price behavior, that's a market index of representative groups of securities at any given point in time. Now, most people don't even know that there's a difference between a market average and a market index. So you don't have to worry about it. The book goes into detail about how to calculate it. I don't care. It's done for you. You just look it up. And you cannot help but hear about these every day in the news. The Dow went up, the Dow went down, the NASDAQ went up, the NASDAQ went down, the S&P. What are they? As we said, they are just lists of companies or stocks, companies, or bonds, if it's a bond index, which most people don't watch, but it's the stock indices are much more popular. That's all it is. It's just a list, folks. Now, it's very important because we measure our mutual fund performance. We measure our own performance against these indices. So they become, did you beat the market over decades or over last weekend or whatever. So slide 49. The share price calculation, the market average, and the market weighted calculation, the market index. Again, I told you not to worry about the difference because in reality, there's really only a couple of averages that are important. The one being the Dow Jones Industrial Average, plus the transportation average, and then the utilities average. Those are the only ones you'll ever hear about. Everything else are indexes. And you see, the problem with an average is you're just looking at the price of the stock without regarding to how much the stock is worth. Whereas when you look at an index, you're looking at the price of the stock plus the value of the stock in the index, the capitalization, which we'll take a look at later on in another presentation. The larger the company, the more influence that security, in this case we're talking about stocks, will have in the index. So the Standard & Poor's 500 stock index. And market-weighted calculations were generally regarded as a better measure until the bubble of the late 1990s. Nothing's perfect. So averages were considered, oh, you know, we need to be more precise, and that's why we've come up with indexes. And even they are not infallible. Slide number 50. So now you want to be writing these down. Well, write the most important ones, 7 or 8 of them. And there's a worksheet, so you're going to go through the worksheet and reinforce your knowledge of these, because these 7 or 8, I want you to know. I want you to know these. There are dozens and dozens and dozens of these things, folks, so don't try to learn them all. The most popular, the oldest, 1896, is the Dow Jones Industrial Average. Remember, Dow Jones is the people. That's the company. That's the company that owns the Wall Street Journal. Well, not anymore. They now are owned by Fox News. And it looks as though Dow Jones doesn't even take care of the Dow Jones Industrial Average anymore. It looks as they've sold that to Standard & Poor's. I can't get a definitive answer from looking at their websites. You find out and tell me. This stock market average is made up of 30 high-quality stocks selected for total market value and broad ownership and believed to reflect overall market activity. It's certainly the most famous of the stock market measures. Even though, dear students, it's not the best. It's actually not very good anymore because of the nature of the industry. It changes from time to time as companies and industries evolve, and as such, it now has more non-industrial stocks than industrial stocks. So why do they still call it the industrial average? I don't know. There's only a few industrial companies left. Slide number 51. Here are the 30 stocks as of this presentation in the Dow. And yeah, General Electric, United Technologies, ExxonMobil, I guess is, Caterpillar, right? Earth moving equipment. But 3M, what are they? What, Nike, Pfizer, Coca-Cola, and Disney? McDonald's, industrial? What's going on here? Well, exactly. What's going on is that the world is changing. Industrial stocks are not the only game in town. Now we have healthcare and drugs and insurance companies and investment companies and finance companies like Goldman Sachs and JP Morgan Chase and Bank of America, right? Bank of America's in there. Oh, no, they're not. No, they're not. They're not. No, Bank of America's not in there. They took them out, right? They took them out when they crashed and burned. And so, yeah, I wish at the very least they should change the name. Just call it the Dow Jones Average. Because Apple, what is that? Apple's a tech company, yeah. American excuse. Any companies you don't know? Well, I want you to do the 82 years ago. 82 years ago, there's a handout on the website and in Canvas. Don't peek. Don't peek at the one that says don't peek. And decide which one you want. And then see how well you did. Okay, so and we discuss the 30 in more detail. And here, these are great companies to research. By the way, if you don't, who are Merck and Pfizer? They're drug companies, folks. Who's 3M? 3M, Minnesota Mining and Materials. They make Scotch tape and Post-it notes. They make, I think, 100,000 different products. Most of them all flat. Travelers is an insurance company. United Healthcare Insurance Company. Who else do we got there? Chevron Oil, Exxon Oil, Microsoft, obviously, IBM, Intel, tech companies. Goldman Sachs is an investment banker. JP Morgan Chase, a bank and investment bank. Yeah, so you know most of these. And Cisco, Internet Technology. So check them out. But remember, these are only 30 stocks. And because there's only 30, just one of them going up or down on any one day can skew the average quite a bit. Yeah. So it's not the best. But it's certainly the most popular. So that's what we're stuck with. You can't tell NBC and CBS and all the others to not discuss it, because they'll go, "What are you talking about? We have to. Our viewers want it." Okay. What's happened over the last 100 years or so? Well, there are times when the Dow Jones Industrial Average basically doesn't really do much. Well, that's not true. It does a lot, but it winds up back in the same spot it was 20 years ago or whatever. So look at the example. 1906 to 1924, it went from 100 to 100. Well, that's masking the wild ride that it had in between. And then from 24 to 1929, it went up by a factor of 3. And then we know what happened, the Great Depression. So it wasn't for 25 years until it finally got back to where it was in 1929. And then it rose by a factor of 3 again over the next decade or so. And then there was another wild ride from 66 to 82 where it went up. It started at 1,000, down, up to 1,000 again, then down, and then finally back up to 1,000 in 1982. 16 years. 1982 to 2000, it skyrocketed. There was 2 directions that the stock market went between 82 and 2000. Up and way up. And then between 2000 and 2011, it took 11 years, right? So folks, how do you make money in stocks during times when the markets and the capital gains are flat? Well, it depends. The answer depends upon whether you're an investor or a speculator/trader. And I submit to you that it's easier to be an investor over the long term because all you do is you just sit tight and you buy more shares as the price goes down, and maybe you buy fewer shares if you're doing dollar cost averaging as the price goes up, and you build wealth slowly. And when those times that the stock market's doing really great, fabulous, fantastic, everybody's partying, thank you very much. And when it's not doing so great, you got plenty of time. It gives you more time to buy more shares. If you're a speculator or a trader, you have to be right twice. You have to buy at the right time and sell at the right time, and then you got to do that over and over and over again. In which case, I wish you much luck. But I certainly can't help you because I don't know when it's going to go up, when it's going to go down. And in fact, we're going to take a look at a few other instruments, especially the one called Don't Lose Perspective. It's coming up in a later presentation. But it shows you trying to guess from month to month is forget it. You'll drive yourself insane. You might as well flip a coin. And some people do, and that's only 50% too. So you want to be, in my humble opinion, I've said it before, I'll say it again, prudent, long-term investor. Buy when things are going down, buy when things are going up, buy fewer shares when things are going down. Buy more shares when things are going down because you're dollar costing averaging. Buy fewer shares as the markets go high because you're dollar cost averaging, and let's hope that the world doesn't end. Slide 53. Now, Dow Jones have other averages, which again, I think S&P actually runs. I haven't figured this one out yet. But the transportation average looks at 20 railroads, airlines, freights, and that one people often look at. Why? Because the transportation industry often is a leading indicator of an economic upswing or downturn. Why? Because things have to get to where they're going to be built and put together, and they got to get from where they were built and created to where they're going to be sold. Yeah, so that's, people watch that. The utilities, utilities are for people who get older like me and want something stodgy and reliable because utilities ain't going anywhere, right? They're not going anywhere. And so you put them all together. You put the industrial, the transportation, utilities, and you get the stock composite average of 65s. I don't know anybody who watches those. Now, the next two are important, and we'll come back to these. The Dow Jones U.S. Total Stock Market Index and the Dow Jones U.S. Completion Total Stock Market. Who came up with these names? I wish they would change it back to what it was, and what it was the Wilshire 5000 and the Wilshire 4500. And I don't know if you remember, but when you did the Chapter 4 assignment, the S fund in the Thrift Savings Plan, that's the U.S. Completion Total Stock Market Index, or what used to be called the Wilshire 4500. So the Wilshire 5000 is the largest 5,000 stocks in the United States. Now, some of them are outside the United States, and there's more than 5,000, depending on how they want to play with it. But the Wilshire 4500, what they did is they took out the S&P 500 stocks. They took out the largest companies, the 500 largest companies in the S&P 500, from the S&P 500. So you see what happened? they are taking away the large company stocks. And that's why it's the S fund, even though it has lots of mid-cap funds, lots of mid-cap companies in it. That's why it was the S fund in the thrift savings plan. And the Dow Jones Internet Index, I include that because it is an interesting case example. It came out, I think, in 1999, right before the internet bubble burst, and promptly lost 96% of its value. Talk about bad timing. Okay, slide 54. Here it is, folks. This, dear students, is more important than the Dow, but doesn't get as much press. The Standard & Poor's 500. We've already been discussing it quite a bit all semester long. It's traditionally the largest 500 companies based in the United States, but now it contains some foreign stocks. Why? Because some of our largest companies were bought by companies outside the United States, and so they said, "Oh, all right, let's include Daimler Chrysler." When Daimler-Benz bought Chrysler, and then after 10 years sold them, they bought them for $36 billion and sold them for $7 billion. Yeah, the Germans took a bath with Chrysler. It's a very popular index, although it's lost some of its original focus. Why? Hang on a minute, because some companies have gotten so large that they skew the index. Remember our discussion of the skewed index back in chapter 4? We're going to come back to that. Because the Standard & Poor's 500 is market weighted, it was affected by the tech bubble of the late 1990s in a bizarre manner. This is I'm referring to that slide we talked about in chapter 4. The market values of a small percentage of technology companies were inflated to large extremes. This skewed the index even more toward those companies. Consequently, in 1998, 10% of the gain in the S&P 500 was due to one stock, Microsoft. So you see what was going on? And because of the way the index is created, the more the company is worth, the more value it has in the index, which means the index funds have to buy more of it. So it becomes a feedback loop that they have to buy more, which makes the value of the stock worth more, which means the index funds have to buy more, and it's a cycle that cycles up until the bubble bursts, and then on the way down they have to do the exact opposite. As the stock becomes worth less, they have to sell more of it, which means that the stock becomes worth less, which means they have to sell more of it. So you see what's going on? Whenever anybody tells you that an index fund is the perfect investment, you remind them of this, and they probably won't understand you, and maybe you still don't understand it, but no investment is perfect. Okay, I think we've got that in. Yeah, every investment has advantages, every investment has disadvantages. And of course, Standard & Poor's has dozens and dozens of other indices. The mid-cap 400, the industrial 400, small-cap 600. You put the S&P 500 and the mid-cap 400 and the small-cap 600, and you get the 1500 index, and then the transportation, utilities, global, international sector indices. And nobody ever consults these, but it's nice to know that they're there in case you ever want to. Yes, make sure you know this S&P 500. Slide 56. Now, the New York Stock Exchange, the AMEX, the NASDAQ. Remember, it's the New York Stock Exchange market, whatever, MKT. And the NASDAQ 100s. Well, the only one of these four that's very important is the NASDAQ Composite. It's sometimes called the tech index. Why? Because many of the companies at the NASDAQ are technology companies. But remember, there's other companies that are not technology companies in NASDAQ, so it's a little bit muddled. But what happened to the NASDAQ? Between 1995 and the year 2000, it went from 800 to 5,000. In fact, in 1999, it gained 85% in 1 year. It then dropped to 1,200 in 2002. So between March of 2000 and October of 2002, it lost 80% of its value. Yes, that's how big the tech bubble was. And as I said, many companies that were old technology, old economy, were losing value in the late 90s. And you have to be aware of this, dear students. You have to be aware. Not much you can do. You can watch it. But realize that if you buy an index fund, the index fund has no choice. They can't say, you know what, all these old economy stocks, they represent pretty darn good value, where these new economy stocks, not too good. Your index fund is not allowed to do that. They have to buy, or have to sell. Slide 57. A few others that we want you to, well, the two others that we actually have already discussed. And that's the U.S. Total Stock Market Index, which I wish they still called the Wilshire 5000, but they don't. And the Extended or the Completion Stock Market Index, the Dow Jones U.S. Completion Stock Market Index, which used to be called the Wilshire 4500, but they don't call it that anymore. So you have to learn those. And then they got some few S&P has theirs and MSCI has theirs. Who are they? Hang on a minute. Okay, so let's now take a look at the last three that we're going to ask you to remember. The Russell 2000. We saw that S&P 500 had a mid cap, a small cap. Well, the most popular one is the Russell 2000. That's the one you'll hear. And Russell is another company like S&P and Dow Jones. And what they did is they created the Russell 1000, the Russell 3000, and the Russell 2000. What's the Russell 1000? It's the top 1,000 largest companies. And then they took the top 3,000 companies and they lopped off the top 1,000. And that's the Russell 2000, which is the universe of small and mid-cap companies. And that's the more popular one. That's the one we use when we want to know how the small companies are doing. When we compare them to the large companies, the pundits and analysts on television and on the internet will point to the Russell 2000. Cool. Okay, so if you didn't understand that, rewind it and make sure you take the top 3,000, you lop off the top 1,000, you're left with 1,001 through 3,000. Yeah. Now, the MSCI. Now, you don't have to remember that this is Morgan Stanley Capital International. I'm going to give you a little bit of history of how this thing was created. But how do we look at the world other than what's going on in the United States? Well, that was a question that companies like T. Rowe Price and American funds, the capital group that we talked about, were asking themselves in the 60s and 70s as they had started to invest outside the United States. They weren't the only ones, but they were one of the first. And Mr. Templeton, before his funds were rolled into Franklin Templeton. So what Capital International, what part of the capital group that runs the American funds, is they created an index called the World Index. But that's not a good thing to be creating a measurement that you're going to measure yourself against. You see the conflict of interest? Hey, we're doing great. Well, you created the measurement. Well, okay. So they sold it to Morgan Stanley, but Morgan Stanley keeps the Capital International there, so that's why it's called Morgan Stanley Capital International. But all you have to remember is MSCI. You don't have to remember what it means. And all you have to be able to do is identify it. And the World Index was used for the global developed world, right? United States, Canada, Western Europe, Japan, Australia, Singapore, Hong Kong. But they've never added the developing world. So instead of changing the World Index, they've created a new index called the MSCI All Country World Index. All right. It's All Country World Index. Okay, I don't know. The index that was used to look at the rest of the world other than the United States was called the EFA, and that's how it's pronounced. It stands for Europe, Australia, and the Far East. But they've never added the developing world to the EFA. So again, they created a new index that includes the developing countries, and it's called the MSCI All Country World ex-USA Index. You see, they should have asked me. I would have told them, just keep it, change the name to something, I don't know. But anyway, that's what you got. That's what you have to remember. You just have to be able to identify it, okay? You should remember it, but if you can't, it's stupid enough to remember. All Country World ex-USA, and that means everybody except for the United States. So we would compare our global fund to the World Index or the All Country World Index, and we would compare our international or foreign fund that invests outside the United States to the EFA or the All Country World X USA. Okay, so now, you don't have to do it right now, but eventually this is what we do in the face-to-face. We would run on over to the stock worksheet number 1, and that contains the indexes that you should know by name. The 8 indexes, and I've mentioned them, and I don't know if I'm going to remember them now. The Dow, the S&P 500, the NASDAQ, the U.S. stock market completion, right? The Russell 2000, the World Index, which is becoming the All Country World Index, All Country World Index, and the EFA, which is now becoming the All Country World X USA. Now, how was it, 7 or 8? 7 or 8, I can't remember exactly which. So check those out. Make sure you know them. All right? Okay. Do the worksheet. That's your study guide. You can do it. We're almost done. Okay. Slide 59. What you're going to see every day on the internet, on the news, you're going to see this graph. Today's unstable stock market started off and then zoomed up by 12 noon. It was crashing down and then came back up pretty much to where it started. Why? Because they have to sell newspapers. They have to sell internet advertising. They have to sell eyeballs to the television advertisers. And so they want you to believe that the world is crashing and burning and volatile. And what are they doing here, folks? There's a wonderful book called How to Lie with Statistics that if you are at all interested in statistics, which I am, I read a long time ago, and it's just a lot of fun. It was written back in the 1950s, so the numbers are way off. But still, it shows you that what they're doing here is they're basically lopping off the first 20,025 points in the Dow, whatever those points mean. It's just an arbitrary measurement. And if they were to show you, so I call this the stock market index mania, if they were to show you the whole amount of the Dow, or whatever index you happen to be looking at, it would look like this on slide 60. And we call this stock market index ennui. Do you know what ennui means? It's a French word that means beyond boredom. Yeah, you're not going to see this on the news because it doesn't sell eyeballs, it doesn't sell advertising. But that's what's going on, right? Any one day, just don't worry about it. Relax. Just tomorrow it's going to change anyway, like the weather. And so now, dear students, we can revisit. I told you we're going to revisit. We can revisit the volatility that we saw in the previous, 2 presentations ago. Remember, it looked pretty darn scary. But if we show you the entire your entire $10,000 investment and how well it's done or didn't do, it doesn't look so bad, does it? No, it doesn't. This is what we need to do. We need to replace that fear and emotion, that scariness with, hey, in the grand scheme of things, it's not a big deal. And by the way, you're not going to see this graph on the nightly news, right? No. It just ain't going to happen. Because, as we said, they got to sell newspapers. They got to sell advertising. They want to scare you. Be afraid. Be very afraid. Yeah, okay. And so, we are finished. Okay. What do you think, folks? Go back over this, right? You need to study this stuff. I am so proud of you. You're working hard. You're going to be awesome. You're the investment gurus for your friends, your family, your coworkers. And as I hope you're seeing that once we can control our emotions, once we can learn techniques to deal with the volatility and the scariness, and yeah, it's not fun, but we know it's like kind of like a storm, it's going to pass. This stuff isn't really that hard. It really is not that hard. As Warren Buffett likes to say, investing is simple, but it ain't easy. Right? Okay, now in our next presentation, what are we going to do? Well, we've got more stock market characteristics to take a look at, more measurements. We're going to do some calculations, and we're going to take a look at dividends in detail. Yeah? Okay, cool. So we'll see you in our next presentation. Study stock worksheet number 1, study the presentation, read, check out the links that are there for you. Have fun. Enjoy. I hope you're enjoying the class. Take care.